Now, back before, of course, all we did was talk about tariffs. All we did was talk about data centers and the AI boom, so to speak. Of course, you were one of the biggest, certainly, cheerleaders, the revolution, so to speak, Dan. We're trying to determine where spending is right now. Every day, investors are still trying to figure out, is Microsoft backing away? Is OpenAI filling the gap? Is CoreWeave, going to actually be a key beneficiary in some way? On and on from there. We haven't heard from any of the hyperscalers yet in terms of their spending plans. What are you hearing and what are you expecting?
So in terms of like the abandoning data center and just all the controversies there, I strongly disagree from all of our work that that's happening. Now, again, is there reallocation on the edges? But I continue to believe when I think about the $325 billion in CapEx, you could maybe see some of that get a bit lower. But ultimately, what I'm seeing from a hyperscale and big tech, I mean, they're plowing ahead. Because the reality is that they recognize that it is still an arms race. So you talk about AI revolution is still here. Despite tariffs and all the uncertainty and sort of the twilight zone we're going through, but no tech company wants to be the one where I'm going to pull back, you're going to go ahead, and then I'm behind. And I think the narrative I expect to see in earnings season, not about the guidance, it's about them basically recommitting, because that's what they're hearing from their customers. And we've talked about it. We've already cut numbers 10% across the board. But I think factored into these stocks are 10, 15% earnings cuts across the board already in terms of where we're looking at.
In 2025, the market is still erratic, with stocks typically trading far below their peak values. This presents some possible chances for long-term investment. Investors can take advantage of the choppiness that is likely to persist by purchasing hypergrowth stocks this year at a discount to the share price. To be clear, companies that have recently had revenue growth of 30% or more are represented as hypergrowth stocks. Long-term investors should now examine these hypergrowth stocks more closely. Nvidia undoubtedly falls into the hypergrowth category, as evidenced by its sales growth of over 100% last year, including 78% in the most recent quarter. It is not valued as a hypergrowth stock, though, with a price-to-earnings ratio, PE, of 21.5 times this year's analyst expectations and a price-earnings-to-growth, PEG, ratio of 0.4. Hypergrowth equities frequently trade at premiums, whereas stocks with pegs less than 1 are generally regarded as undervalued. Concerns about the effects of tariffs and additional export limitations for its chips to China have put pressure on the stock. Given that 11% of its sales were made in China last year, the latter will undoubtedly have an effect on its operations. However, the company's development has never been significantly fueled by the selling of scaled-back chips to China, and there is still a strong market for its graphics processing units, GPUs. Even if Nvidia experiences a significant drop in sales to China this year, the company should still enjoy robust growth as a result of continuing to ramp up manufacturing of its new Blackwell processors. However, as the H20 and H100 chips have the same design, I would expect the business to potentially shift its H20 chip manufacturing capacity to other GPUs. Furthermore, I anticipate that certain Nvidia GPUs will still be sold on the illegal market in China. Nvidia still has a huge opportunity ahead of it despite all the commotion, as businesses continue to hurry to construct data center infrastructure in order to keep up with the growing demand. Cloud computing firms are spearheading this expansion by helping clients create their own artificial intelligence, AI models, and applications that utilize their infrastructure platforms. In a haste to develop their own AI models, a number of businesses are concurrently making significant investments in their own data center infrastructure. More GPUs are required since these models demand exponentially more processing power to advance from earlier iterations. With more than 80% of the GPU market, Nvidia is still in a solid position to benefit from the AI data center build-out's anticipated robust, continuous development. So what implications does this have for Nvidia's stock? Let's explore that. But first, a big thank you to those of you who've stuck with us this far. Creating these videos takes significant effort and dedication, so if you're enjoying the content, please hit the like button, subscribe to our channel, and share your thoughts on Nvidia stock in the comments. Your support truly helps us grow. Now let's get back to the video.
I thought this was the bounce back week for markets. What do you make of the action this week in names like Nvidia?
Well, I think it's very understandable. And by the way, it's great to see it twice in 1 week, pal. But I think it's fascinating to see the chips. The chips are what led us up in 23 and 24. It certainly what led us down. And I have been skeptical and critical when we saw Nvidia up over 150. 153 was a high. But I think we're in oversold conditions. But I think we are looking for something tangible. I'm not going to say the word uncertainty from tariffs, but we're looking for something tangible. And it's interesting, NVIDIA is kind of being used right now as a pawn, Wilf. If you see the $500 billion commitment, you thought that would encourage the president to help NVIDIA, but nonetheless, we are seeing this opportunity. But I like to look at valuations, Wilf. If you look at the 30% drop down year to date for NVIDIA, which is, by the way, 21% of SMH, which is the semiconductor ETF. But NVIDIA has come down 30%. The forward PE ratio back in January, just this year, was up over 50. Now it's down at 22. So that forward PE of 22 is a 60% haircut. The stock's come down 30%. There's a discrepancy there. I want to be an owner. I bought it in the 90s. I had to take it down to $86 when we saw the post-Rose Garden debacle price discovery. But I think longer term, when you see this tariff conversation, when the VIX go lower, you're going to see NVIDIA lead up the semiconductors, and you will see the AI theme, which took us here, come back to life.
What do you make of the SMH more broadly then? I mean, clearly NVIDIA's still got relatively attractive growth in earnings ahead. Do all of the names have that, or do you think the SMH more broadly has further to fall?
Well, I think if you compare SOXX, SOX, compared to SMH, SMH certainly has more concentration. The top 5 holdings will take about 51%, and the tip of the spear is NVIDIA at 21%. But I think if you're looking for broad swath allocation to semis, NVIDIA has to be there. So I'm okay with the concentration in SMH because I think what led us up is also going to lead us out. And I think right now we have to get some visibility. We're hopefully not going to decouple from China. Hopefully things are going to find a way. Tomorrow's Good Friday. It would be great to get some good news, but I'm not hoping for that yet. But right here, right now, when it feels this bad in semis, this is the time to buy. This is a longer term play. And all that CapEx we saw for all those different companies, Wilf, we are going to see that CapEx come and translate into chips, chip demand. I know margins are coming down for NVIDIA, but they are still the superstar, rock star leader in chips.
Nvidia is well known for its groundbreaking work in graphics processing units, GPUs, which are utilized in professional visualization, gaming, data centers, and the automotive sector. Nvidia's record-breaking success in its most recent financial reports, which were made public on February 25, 2025, highlighted the company's leadership in data-centric infrastructure and AI-driven technologies. Nvidia recorded a record revenue of $39.3 billion for the fourth quarter of fiscal 2025, up 12% from the previous quarter, and a remarkable 78% year-over-year growth. Its data center division, which reported a record $35.6 billion in quarterly revenue, a 16% rise from Q3 and a 93% increase from the previous year, was a major contributor to this achievement. Nvidia announced record sales of $130.5 billion for the entire year, which is 114% more than it did in fiscal 2024. The full-year GAAP earnings per diluted share were $2.94, a stunning 147% increase from the prior year, while the quarter's GAAP earnings per diluted share were $0.89, up 14% sequentially and 82% year-over-year. NVIDIA's rapid financial expansion is a result of its strategic emphasis on deep learning and artificial intelligence infrastructure. In a recent meeting with Japanese Prime Minister Shigeru Ishiba on April 21st, CEO Jensen Huang pushed for more electricity production to satisfy the rising power requirements of AI computing. The two leaders emphasized the urgent need for new infrastructure to support energy-intensive AI systems, while talking about Japan's distinct advantages in the field of artificial intelligence, particularly its proficiency in robotics and industrial production. Investor trust in NVIDIA is still high in spite of these outside obstacles. Analysts see a significant upside potential of 74.7% for the company, which now has a price target of $169.30. This places NVIDIA third on Louis Navellier's list of stocks with significant upside potential, underscoring the company's ongoing attraction to investors looking to profit from the revolutionary development of advanced computing and artificial intelligence. To stay informed about the latest developments from NVIDIA and the ever-changing stock market, consider subscribing to our investing tutorial channel. We provide daily updates on significant market shifts and key catalysts, so hit that subscribe button to ensure you never miss crucial information. We'd love to hear your thoughts on NVIDIA stock, so please share your opinions in the comments below. Now let's dive into today's video.
Especially as we obviously heard from Tesla, we'll hear from Alphabet this week. We'll, of course, hear from some of the other big names next week. They're on sale right now. Are you scooping any of those names up?
I'm not. In fact, I have been probably the biggest proponent of companies like Nvidia. For years, I owned Nvidia stock, and last summer we dumped the stock because it hit one of our sell triggers, which had to do with artificial intelligence and the enthusiasm for that sector. We thought back in the summer we were starting to see waning signs that maybe people have exaggerated the value of artificial intelligence. And I'm lucky to say that right now, I'm sure we've all noticed, AI has really taken a major back seat on all the news items and the concerns. We're also seeing companies perhaps walking back a little bit about how much money they're going to spend in the future in AI because they're now distracted about the tariff situation. So I'm really on the sidelines for most tech like that. I certainly do like cybersecurity because I think that is a staple in all our lives. But in terms of artificial intelligence and the big tech companies, I have stayed away from since last summer.
And what gets you back in there?
I have to tell you that the reality of artificial intelligence, and I've spent a lot of time looking at this, and I have a considerable background in technology, so that perhaps will give me a little bit more credibility than most. I do think that artificial intelligence has actually topped out, and I'm probably the first one to ever say that, but in terms of the expectations, I don't think we're going to go any further in the development until we have a major breakthrough. So for now, I can't foresee any sign that would bring me back to a company like Nvidia unless...
As the Trump administration suggested a de-escalation of the U.S.-China trade conflict, big tech stocks rose for a second day on Wednesday, with the Magnificent Seven companies adding $455 billion to their market capitalizations. Following Elon Musk's announcement late Tuesday that he would be drastically cutting back on his time working for the Trump administration, Tesla's stock rose more than 5% on Wednesday. Amazon, Meta, and Nvidia all saw increases of about 4%. Microsoft, Google, and Apple all saw increases of about 2%. The advances on Wednesday followed President Trump's softer stance toward China and his suggestion of a possible exemption from the historic 145% reciprocal tariffs on Chinese imports. At a White House news conference on Tuesday, he stated that the present rate is too high and will significantly decline. According to Trump, he intends to be very nice to China in order to negotiate a trade agreement. At a private gathering in Washington, D.C., on Tuesday, Treasury Secretary Scott Bessent independently referred to the U.S.-China trade war as unsustainable. Although Bessent denied that the U.S. would think about unilaterally lowering the high tariffs on Chinese imports, he did publicly affirm that opinion on Wednesday. The value of the Magnificent Seven has increased by over $843 billion since Monday's market closing. Before the surge in tech stocks, the group had lost $1.8 trillion between Monday's closing and Trump's announcement of reciprocal tariffs on April 2nd. Given China's significance in their supply chain, tech businesses would benefit from any possible respite from Trump's hardline, unheard-of trade strategy. According to a prior research by Dan Ives of Wedbush, about 90% of Apple iPhones are manufactured in China. In 2024, 17% of Apple's income came from China. In the note to investors earlier this month, Ives also pointed out that Tesla sources a considerable amount of its batteries and parts from nations like China, and that the escalating trade war with China will not help the EV company beat domestic rival BYD in one of its most crucial markets. Wall Street was disappointed by Tesla's first quarter earnings release on Tuesday. According to Raymond James, which recently downgraded the company, Chinese marketers accounted for 14% of all Amazon advertising spending in 2024, and 30% of the total value of goods sold on Amazon originate from China. 11% and 6% of all ad expenditure on Meta and Google, respectively, is attributed to Chinese advertisers. Gil Luria, an analyst at D.A. Davidson, estimates that between 20% and 40% of Nvidia's end users are from China or Chinese businesses. By imposing a 10% duty on all imports from around the world on April 5th and announcing the hefty reciprocal duties on important U.S. trading partners earlier this month, Trump shocked international markets. With the exception of a 145% charge on Chinese imports, his reciprocal tariffs, which were originally scheduled to go into force on April 9th, were suspended for 90 days. Last week, a brief respite from electronics tariffs boosted big tech stocks, but officials from the Trump administration hinted that the exemption was only temporary and paved the way for semiconductor duties. The president has pledged that his tariffs will continue to apply to the majority of electronics, which could harm Nvidia and other large tech companies. Last week, the U.S. government also imposed export restrictions on processors made by rival AMD and Nvidia, which caused the stock to plummet. Don't forget to share your thoughts and experiences in the comments below. Your input helps create a more knowledgeable community where we can all learn and grow together in the world of investing. Stay up to date with the latest market trends, insights, and key updates by subscribing to Investing Tutorial. We're here to help you make smarter investment decisions and stay ahead of the curve.
Looking at the market here, we had a nice little day yesterday. The candle structure, if you're looking at the longer term time frame, kind of signified that we had a little bit of a shooting star pattern. They're hitting an area of resistance, definitely at around that 5460, 5470-ish area here. So today, what we want to be able to do is obviously continue to try to overcome that 20-day moving average and push above this wedge pattern that's been taking place. You can look at it as an asymmetric triangle to the upside, and I would look at the 5500 level as being your area of resistance. But once again, that candle yesterday was a little bit bearish, and we have a gap below. And if we are going to test that gap, you could look at around that 5300 level as an area where we do try to test. But in the interim, if we're looking at just the intraday levels, the key areas or spots that I have focused on right now is 5400. That's going to be your immediate area of resistance, or where we could see maybe some pressure in the market and some resistance here. But if we're able to break above that, we're still looking at 5480. We had that on the radar yesterday. We got about 10 points away from that yesterday, but 5480 to 5500 is going to be a key area of resistance. And then to the downside, actually looking at 5220, we did see some earlier flows kind of targeting that level to the downside, and that's a major gap to the downside. Now, that's not out of the ordinary. We still have volatility still, for the most part, elevated, sitting at around 28 to 30, depending on when you're looking at the VIX here. But if we do get a flush to the downside, the first area that I would kind of look at is that 20-period moving average on the 15-minute chart, which is sitting at around 53.16 for right now. Anything below that, once again, 52.20 on the radar here today. You want to see market expansion as far as breadth. And yesterday we saw that initially, Nicole, but we started seeing that backing off a little bit. And if we're kind of looking at the advancing to declining stocks in the S&P 500 right now, we're sitting at around 42%. So I'd like to see a little bit more participation, not really a concentrated type of market with mega cap names and things of that nature here. So I would expect maybe a little bit of volatility here for today. If you're kind of looking at the trade structure itself and the technicals, it kind of looks more that we might see a little bit more of a pullback, but the news flow can change on a dime, and that could actually rally markets higher. But I'm kind of looking for a little bit of a pullback on an intraday basis before we actually get some stability.
The news flow could change and push the markets lower, too. We're ready for anything here, and I'm not saying one way or the other, but certainly we are a headline-driven market. When you look at the yield spread, what is it telling you today?
Yeah, what's actually very interesting, we usually look at the 10-year, 3-month yield spread, but today I'm actually looking at the 10-year, 30-year yield spread. And the reason why, the 30-year has actually been gaining a lot of traction over the last 24 to 48 hours here, after seeing maybe some fracturing last week. But if you look at a 1-year daily chart of this spread here, we continue to see it move to the upside. Now, that upside normalization is a good thing. That's what we really want to see if you're, want to normalize markets and kind of get towards an early cycle, early, stage type of behavior when you're looking at the economy. But unfortunately, that spread widening out to the upside is also probably putting more pressure on the S&P 500. I only have a daily chart here, but if you even go back last 20 years or 30 years looking at this spread here, usually the rapid move to the upside or the rapid normalization in this curve does also create a little bit of volatility here. So if you're a trader, you'd like to see this kind of stall out, maybe pull back to the downside, even though that probably would not be the best thing, especially for if you're looking at the Fed and trying to take action here. But if we can continue to see this acceleration where the 30-year yield is spreading out wider than the 10-year yield, once again, a normalization that can once again provide maybe some headwinds when it comes to the overall market here. We had a decent auction yesterday when you're looking at the 5-year. We had a 2-year auction the day before that was not so great. So we'll continue to keep our eye out on that, looking at foreign demand. And obviously the turbulence that we're seeing with between China and the United States. China's a pretty decent buyer, a pretty big buyer of U.S. treasuries. And if we start seeing them back off a little bit as a sign or maybe a pressure item for the administration, that's where you can continue to see maybe yields on the longer end of the curve starting to widen out or actually pushing even higher here to the upside. So something to be mindful of. But we are seeing the longer end of the curve, especially on the 30-year, some selling activity kind of taking place here a little bit more aggressively than what we saw maybe a month ago.